Okay, so if you have watched my previous videos, then you'll get a clear understanding of what price trends are and how to analyze them across multiple time frames. It is time to take it a step further. Now we're going to be looking at how do we capitalize, like how do we extract funds out of the market when it's trending. So in this video, we'll be speaking about entries. Now, ideally, when a market is trending to the upside or when price is in an uptrend, you would want to capitalize or get your entries in on a pullback. That would be the ideal spot that you would want to get an entry in. So in the case of this video, we're going to do something different and we'll be looking at the currency pair Australian dollar versus the Japanese yen. So in this particular case, we have a ridiculous uptrend. Like this uptrend started from all the way in April of 2025 last year, and it's been moving to the upside ever since. This is something you would want to capitalize off of, and I'm going to try my best to show you how you can do that. So let's first combine the knowledge that we have from the previous video to this one, and then we'll move forward from there. So what we want to do is we want to identify the dominant trend, and if you look at the weekly chart, it's an uptrend. Good, we identified the dominant trend, uptrend. You go down to the daily time frame and you look at what is the current market structure. So for the purpose of this video, what I'm gonna do is I am gonna remove Friday's price action. Now we're only looking at everything last week up to last week Thursday. Seeing that we already identified the dominant trend on the weekly time frame, we're going to mark out the market structure for that trend on the daily chart. But we want to stay as close to price action as possible, so I'm only going to mark out the most recent low and the most recent high. So at the moment, this was the most recent high, and this was the most recent low. So now that we marked out the most recent high and the most recent low, let's see what the market is telling us. So as you can see, we're in an uptrend and price action formed this high and then it went down and it formed this low on the daily time frame. It pushed forward and it formed this high up here, and then we got a pullback. So we're gonna mark this out as a high. We don't know if this is the higher high yet, and we're not gonna call this the higher high until we get a higher low. So we need to see price form a low that's higher than this low before we can say, okay, this is the higher high. We haven't gotten that yet, so we're not gonna call it the higher high. We know that it's higher than this high, but until we get the higher low, we're not gonna count this as a higher high, because price action can do something, I'm telling you, price action can do something like this where it just start going up again, and then this wouldn't be the higher high. So until we get a higher low formed, we're not going to call this a higher high. So now that we have those in place, we're going to look for entries. You would go down to your lower time frame. So when you go down to the lower time frame, seeing that we identified the trend and we identified the structure of that trend, we know exactly where price is. We know that price formed a higher low recently and then it pushed past the most recent higher high. So now we're trying to see if this is the new higher high. In order for us to call this the new higher high, price have to put in a higher low. So now the question is, where would that higher low be formed? Using the information we have on the screen on the 4-hour time frame, we can see that over here was once resistance. So we're going to take this and we're going to draw a zone and we're going to stretch it across the charts. And we're going to say, because what price likes to do is price likes to turn what was once resistance into support. It also likes to turn what was once support into resistance. So price is pulling back, then this would be an ideal spot for it to pause to turn resistance into support, because as you can see right here, When price formed this high and it came down here and it formed this low, we had an issue getting above that zone right here. And we had that problem for, this shows you. So after we put in this high, we had a problem pushing above that high for 2 days. So this high held for 2 days before we finally broke above. So now that we broke above, price came back down to test that area of resistance to see if the sellers are still at this level to push price back down to the trend line to test another support, or is the bulls here to push the market to the upside. That's what we're looking for when price gets to here. So this is your decision point right here. That is the most information you're gonna get when just using what the chart is showing you. So this is where we gotta step up our game a little bit, and we're gonna get into using tools. Now, one of the best tools to use when price is trending is called a Fibonacci Retracement tool, or a Fib Retracement tool. And what the Fib Retracement tool does is it shows you levels or areas in the market that price will return to when trending. If price is trending to the upside, it shows you levels or areas of support that price might return to when it's pulling back. And if price is trending to the downside, it shows you levels or areas of resistance that price might return to pick up more momentum to continue with the trend. So this is actually what it's going to look like. You're going to see these numbers to the side in decimal points. Now, in order for you to understand what I'm about to tell you, I'm going to change the settings from decimal points figures to percentage. And let me move it from the left to the right so that it displays on the right. So when we're looking at the Fibonacci Retracement tool, what these levels are telling you is that they're indicating areas on the chart that price is likely to pause before continuing with the trend. For example, if price is in an uptrend, these areas, when you apply them to the chart, these are levels or areas in the chart that is telling you, hey, there's a possibility that price would find support at these levels whenever it is trending to the upside. It's also telling you that there's a possibility for price to find resistance when trending to the downside at these levels, depending on what the trend is. Now, there are only 3 levels on the Fibonacci Retracement tool that traders pay attention to, and that would be the 38.2%, the 50%, and the 61.8% levels. These would be the most important levels on the Fibonacci Retracement tool. Reason being, when price is pulling back, like if it pulls back and pauses at the 23.6% level, that ideally would not be a solid pullback. So say for example you're in an uptrend and you see price do something like this and pulls back to the 23.6% level. As you can see, it doesn't really look like a pullback if you compare it with the previous pullbacks like this one. If you look at the distance and you compare, you wouldn't call this right here a pullback. Only when it gets to here, then you can say, okay, that looks like a pretty solid pullback. Or when it comes down to here, you can say, oh, that's a double bottom for the trend to continue. So traders don't really count the 23.6% as a solid level for price to pull back to, but sometimes it also depends on the trend. Like if you have a trend with a strong momentum, then the pullbacks are not going to be steep. But then if it's a slow trend, then you might get some pretty steep pullbacks. It's the same for if price pulls all the way down to the 78.6%. Now that's starting to look like a lower low. So now it's starting to look like the trend is over and we might get a trend reversal. That is why traders normally focus on those 3 levels: the 38.2%, the 50%, and the 61.8%. Those are your ideal levels for when price is going to give you a reversal or a pullback. So what I normally like to do is whenever I apply my tool to the chart, the levels that I don't focus on, I would remove them from the tool and I would only keep the levels that I focus on, because I know when price gets to those levels, that's where I would be looking to take my entries. So if price is in an uptrend and it pulls back to the 38.2%, I'm going to be looking at the chart to see if I'm getting price action that's indicating that it's ready to continue moving to the upside. If it pushes below the 38.2 and goes to the 50, I'm going to do the same thing. If it pushes below the 50 and goes to the 61.8, I'm gonna do the same thing until I get indication that the market is gonna continue with the trend. Then I would take an entry. Now in the case of this particular chart, I marked out all the information that I already received from the chart itself, but now I need something else to confirm my suspicions. I would need the Fibonacci Retracement tool, because I want to know, does the Fibonacci Retracement tool confirm this area as an ideal spot for price to pull back to? Now the way you apply this tool to the chart whenever price is trending to the upside is you'd first want to identify your most recent swing low, which would be this low right here. And this is your most recent swing high on the daily chart. So the way you would apply the tool to the chart is you will take your Fibonacci Retracement tool, this tool right here, Fib Retracement tool, you'd place it at the most recent low first. And then you're gonna drag it all the way up to the most recent high. So when we do that, we can see that the 38.2% level, it lines up almost perfectly with this zone right here, which was once resistance over here, and it lines up perfectly with the 38.2% level. If you also look here, we can see that this 50% level did also act as resistance. So this is telling you that resistance was also in here. We didn't get this price action yet when price was here, but still there was resistance here even though we didn't move to the upside yet. So that shows you how solid the tool is. So this right here by itself is perfect, but there's only one problem with this. We're on the 4-hour time frame. That's the only problem. And you probably don't understand what I mean, so let me explain it to you. Remember, the most recent swing low that we applied the tool from is the daily time frame most recent swing low. But we're not applying the tool to the daily chart. We're applying the tool to the 4-hour time frame. That means we have to identify the most recent swing low and the most recent swing high on the 4-hour time frame as well. And if you look at the chart, this is a low on the daily time frame. It is also a low on the 4-hour chart, but it's a daily time frame low. On the 4-hour chart, when price action formed this low, we made a push to the upside and we formed this high. We came back down and we formed this higher low. Then we formed this relatively equal high. Then we form this higher low again, and then we form this high. This is what price action did on the 4-hour time frame. So what that means is this would be the most recent swing low on the 4-hour chart. This right here, this is your most recent higher low on the 4-hour chart. So seeing that we are currently analyzing the 4-hour chart, we have to apply our Fib tool from the most recent swing low on the 4-hour chart to the most recent swing high. And then it's going to be looking like this. So now the levels, they move up a bit. This was a solid level of resistance, but the Fib tool does not align with it properly. So that is kind of telling you that, okay, this level may or may not hold as support. But if you look at where the 50% level lines up with, it lines up with this right here. So it lines up with this level of resistance over here. Now we're saying, okay, we were getting resistance in this spot as well. So if price should turn one of these levels into support, it could either be this level of support right here or the one below it. If you look at the 61.8% level, again, you can see that these levels of resistance also line up with it. So now we're like, hold on. So we were also finding resistance over here. So that means there is a possibility for price to come here and then continue to the upside. There's also a possibility for price to come down here first and then continue to the upside. And there's also a possibility for price to go even lower to this level right here and then continue to the upside. So we're looking at 3 different possible outcomes of what price action can do right now. We don't know which one price action is going to follow, So what we need to do in this particular moment is we need to wait for price action to play out. Now we need faster information on what price action is doing. We're not gonna get that information on the 4-hour time frame because one of these takes 4 hours to close. So we gotta go down to the 1-hour time frame because one of these candlesticks takes 1 hour to close, so we get more confirmed information faster. And what we're looking for on the 1-hour time frame is price action showing you that we're finding support and we're ready to move to the upside. What does that look like? That looks like this. That's going to look like this spot right here. We're going to see price push into one of those levels and then lose momentum by forming candlesticks with smaller bodies or forming dojis like this. You might get a bunch of them in one spot, or you might get one candlestick pattern that has a small body indicating price reversal. So let's hit play and price action and see what happens. So as you can see right here, this first level of support got broken. This one also got broken, so we're going to take those off. So the 38.2% got broken and the 50% level got broken. But if you look at the 61.8%, we got price trading down into it, but the moment price touched it, we got a reaction where we saw price action moving back to the upside and forming this candlestick right here, which is a doji. And if you know your candlestick patterns, then you would know that a doji is indicating price reversal. So we can even go to lower time frames to see what's happening here. This is the 30-minute time frame. So this is the 30-minute candlestick that had an interaction with the level. We traded down into it, then price pushed back up to the upside. Then this particular candlestick was taken over by the bulls. Then the bears took over and they tried to trade back down into that level again, but they couldn't. And what happened after? We got this bullish engulfing candlestick pattern. Now this is basically telling you that the bears, they lost steam and the bulls took over. So for the last 30 minutes, the bulls were in charge. If you go down to the 15-minute time frame, what do we see? On the 15-minute time frame, you can see clear as day price trading down into that level. We couldn't close below it, and then we traded out of that level. And then what did we do after we traded out of that level? We formed a higher low. So this was a low, this was a lower low, then this was a higher low. This was a high, this was a lower high. Price traded up above that lower high, so now we're looking to form a higher high on the 15-minute time frame. This downtrend on the 15-minute time frame is slowly being broken. So now let's go back up to the 4-hour and let's speak about what we know. We know price is trending to the upside. We know that we were looking for a pullback. We know that we were looking for price to find support either at the 38.2% level, the 50% level, or the 61.8% level. That's what we know. What else do we know? We know that within this particular 4-hour candlestick, price traded all the way down to the 61.8% level, but then bulls took over and they pushed price back up to where it is now, right here. That is your first indication that this was a solid area of support and the bulls are taking over. On the 1-hour time frame, we have something beautiful right here. If you know your triple candlestick patterns, you would know what this is, where we have a bearish candlestick followed by a doji followed by a bullish candlestick. This triple candlestick pattern is known as a morning star candlestick pattern, and a morning star is a bullish candlestick pattern that signals a possible reversal from a downtrend to an uptrend. The morning star pattern consists of 3 candles: a tall black candlestick, a small candle indicating market indecision, and then a tall white candlestick, or in my case, gray, indicating or confirming a reversal of the trend. even though this doesn't look like a clear trend on the 1 hour or the 4 hour, go down to the 30-minute or the 15-minute time frame, this was a downtrend. So on the 1 hour, this is indicating to you that the downtrend on the 15 minutes is going to reverse and turn into an uptrend. On the 1 hour time frame, this is just letting you know that, hey, we found support. We found support, sir. So like, if you're gonna get in, now would be your ideal time to take a buy. So this would be where you get in. And what you would want to do is you would want to target the most recent high on whatever time frame you trade. You'd put your stop loss below support and then you would wait. So the work is done. Now you just gotta wait. We can go down to the 15-minute and watch this play out just to see if that level was actually support. That was your entry. You didn't get any drawdown and we're in the green. Still waiting on that level to be hit, but it's probably gonna get hit because we're in an uptrend. On the 4 hour time frame, this is your entry. This right here is your entry. So you got in after price found support on the 4 hour time frame, and this is actually a beautiful trade. The daily time frame, oh, I'm sorry, I shouldn't went to the daily time frame because then you would see that your take profit would have been hit with like 1 day after. Like, this was Thursday, this was Friday. So we got in on Thursday, and then Friday in the daytime, take profit got hit. So there you go, you're out of the trade. You made some decent profits. You can see this repeating itself over and over again. It's the same thing that happened over a year. It just depends on which time frame you look at. Right, look, this was the daily chart. For example, right here, this was the low, this was the high. Where did we get the pullback? Price found support in this area. It's not exact or precise, but it's in this spot right here, and the 61.8. So this level would be your ideal spot to take an entry. You would have went into drawdown, yes, but as you can see, brother, if you wait and be patient, you would have been good. What about this right here? Would this would we get this trade as well? From the most recent low to the most recent high, you drag it out. We found support at the 50% level, but we wasn't ready yet, so we came down to the 61.8% level. Too much, this is getting crowded. Yeah, we came down to the 61.8% level, and then chiching. Is that it? What about this over here? Like, would this be too small? You could choose the most recent low. These lows are very close to each other, and in this case I would choose the lowest point, which would be this right here, but I'm gonna try all 3 spots and see. Do this. So as you can see, from the lowest spot, the 61.8% level would be ideal, but from the most recent, price found support at a 78.6, which would be too steep of a pullback for me to take an entry right here. So my entry wouldn't be here, but it would probably be in this area when I see price starting to move back up to the upside. Because the moment I see price closing above the 61.8 or closing above the 50% or closing above the 38%, then I would be like, okay, we're going up, let's take a buy trade. So yeah, but that shows you why when we have so many lows in the same spot, like we had this low right here, this low right here, and this low right here, they were relatively close to each other. When I see something like that, I would choose the lowest point, and then that would let me wait longer. So I would wait longer and get in at the 61.8% level, which would still be ideal. This one, you probably would miss this entry. If you only use the fib, I'm betting you that that got to the 23%. So even though we don't really look at this, it is still respected, as you can see. And if you look right here, it just depends on your experience as a trader. but over time you will get it. If you see right here, this was resistance, now it is support. If you still had the 23% level on the tool, you would have got this entry too. The bottom line is, once you understand how price trends work and you understand how to use the Fibonacci retracement tool with price trends, then your entries become more refined and better. So before we end this video, I want to show you one last thing. So in case you were wondering if I cherry picked this chart or this trade just to make this video, I did not. Like, this is actually the entry that I took. But the purpose of this video was just to show you how to use a Fibonacci retracement tool when price is trending. What is a Fibonacci retracement tool? This is basically a tool that shows you levels that price is gonna pull back to. It shows you levels that price will either find support or find resistance.